Thursday, Wednesday, April 30th, and got a lot of economic data. I'm turning into the economist expert again. I'm a bond expert. I'm a stock expert. I'm a crypto expert. I mean, it depends on the day. You know, at some point in time, I'm assuming I'm going to be a proctologist or something of that sort. So I'm going to be an ass expert. And by the way, I got dinged on Spotify yesterday for putting the word boner in there. I apologize to anybody that was offended. I switched it to an eggplant emoji because that's what we do. We try not to offend anybody. And my rant got rave reviews yesterday. So the rant at the end one. I don't think that Spotify threw that out there to everybody. It was a low listenership. It was a good episode, I thought. You know, again, boner pills. It is what it is. But a bunch of news. We got movers like Eat, Brinker, great earnings, OKTA, Weinstein stage 2. I love the space. I will give you a stock that I am putting on the watch list that actually reported yesterday afternoon and was up 10%. I need to check it now. SMCI it just shit the bed. So, and we're going to have a Wells Fargo buyback. I'll go over all of that stuff. CrowdStrike, Starbucks earnings, Grab. We got Meta and Microsoft tonight. Let's start out with the charts. Okay. Here you've got the chart. You've still got confirmation on the 4-hour. Okay. But you got a whole bunch of market data coming out today. You've got GDP and PCE expected tomorrow. Economists start saying how this is the time when economic data, you want to know that good news is good news, is bad news is bad news. And so stock index futures fall as labor data contracts, GDP contracts, eyes on PCE inflation. Okay, US GDP, advanced estimates, blah, blah, blah. We'll go over this. This already came out. Starbucks fell. All of this stuff. Let's just go over the actual numbers because it came out at 8:30. US private sector jobs cooled. The job market is cooling. What does that mean? That means that the Fed can't, they may have to lower rates. Again, they may have to lower rates. As the job market, gets bad, they may have to lower rates. But if inflation starts going bad, and we know yesterday's fight with Amazon, with them showing the tariffs because it's going to increase your prices, make no mistake, it will increase your prices. Tariffs will increase your prices. The reason Trump wants to take income taxes down is because you will have a use tax on absolutely everything that you will buy. And it's called tariffs. It's a use tax. So while they don't want to show it, it will increase your cost of goods. So he wants to lower the income tax in order to do that. And that's how they're justifying it. But when you get a bad jobs market and people don't have jobs and they can't buy things and costs go up, that's stagflation. So understand it's not a good thing. And that's why the market is reacting poorly to that number. And then right after that number came out, US GDP contracts, price index jumps. The advanced estimate of U.S., the PCE, price consumer price index, increased 3.6. That's inflation, excluding food and energy. The drop in real GDP in Q1 reflected an increase of imports, PCE price from 3.5 versus 2.6 in the prior quarter. So inflation is increasing. The jobs market is getting worse. The Fed can't reduce rates because they need to fight inflation, but they need to reduce rates in order to get the job market back on track. It's a conflict. If you watched Brian's show yesterday, it was an 11-minute thing. Let's go to the newsletter because I'm going to show you. Yesterday, Brian Stoffel, I put it in the newsletter. I'm sorry, I don't mean to have that blaring, but in the newsletter, Brian Stoffel had a great video. Go and watch it. This is why he's in cash right here. Why I'm raising cash. It was in yesterday's newsletter. If you don't understand what a bad job market does and what inflation increasing, he goes over it like a master. Okay. And that's what we're starting to see. So what happens? Well, see all that red up in the upper left? That's what happens. The stock market starts crashing. So it doesn't mean you get out, 6 days in a row The Dow added 1% on earnings. S&P posts 6-day winning streak for the first time since September. Things are still good. It's just when news like this comes out and it panics, you're in a range. And so when you take a look at a long-term chart, a weekly, we are just at the 9-day. Okay? The 9-day is 473. Where are you trading in pre-market on QQQ? 466. That puts you a little bit below it. It means you don't have confirmation, but your MACD is super low. Your RSI is at 47. It's coming off at 28. This is what happens during bear markets. You can see in 2022 what happens. You go down, you come back up, you continue down. Now, this is why I say don't go balls deep into the market because things can come down. And I don't believe that we've reached the all-time bottom. Now, is this the bottom April 7th? The low was 402 on the QQQ? Maybe. I mean, we can go and look at a monthly. Remember, monthly chart. April opened up at 467. Okay? QQQ right now is at 466. The hopes was that we would end April positive. That's what the administration over the last few days has been promoting. It doesn't mean that the numbers that came out today won't spur something. There might be some spin on it. But understand you need a strategy. The 4-hour algorithm on QQQ makes you 43% over 24 months. Buying and holding makes you 48%. It's 21 positions, so it's once a month. I also have a Liberation Day strategy that you can import into TrendSpider. It's super simple. The performance chart is right there over the last 9 years, 302% versus buy and hold 322. My plan is to buy when it tells me to buy. You want to know why? It wins 64% of the time over the last 9 years, 14 positions, maybe 1.5 per year. That's essentially what it is. So it's not like you're getting in and out. For me, I want to buy and hold, but I want to know when to get in. Doesn't mean that you're going to win every time, but this wins. Out of those 14 positions, it wins 64% of the time, and it goes back 9 years. And I back tested this against most other bear markets, and it does well. You can see it saved you during COVID. You can see it saved you all of that during the 2022 interest raises. And I back tested against the financial crisis. It's a good. This is why I said don't go balls deep into this. Some of this data just is lagging data. And when you start to see empty store shelves in May, we may start to see more pullback. But 6 days in a row does not make a recovery. Okay, the S&P is up 6 days in a row. Remember, only once the past 20 years were stocks lower on the year when there was a 6-day win streak at some point during the calendar year. So if we go back and look, where did the year start? Okay, the year started, this opened up at 523 on QQQ. You're trading at 466. That would be an amazing move. You don't want to be out of the market when it starts that move. Again, only once in the past 20 years when stocks were lower on the year, when there was a 6-day win streak at some point during the calendar year. This is all playing with numbers. It won't make you feel any better if the market crashes 20%. And the next 6 months historically have been weak, but not lately. The sell in May, there's a big saying, sell in May and go away. Probably not great selling into the strength that we're seeing right now. But if you see weakness, and I'm saying weakness over the summer, again, I don't think there's weakness right now. I think these numbers are troubling. I think there's going to be something like a tariff deal announced because those numbers are troubling. They are going to press the gas pedal down to make sure that the economy doesn't crash. People are feeling it right now. And there's not a positive feeling about the administration. Howard Lutnick was on CNBC yesterday and the market went freaking up. It's bizarro world. So they may announce a deal just to get the news off of hey, the numbers are really, really bad. Because if you go and look, tariffs show up in China, activity, but it can escape the worst. China's manufacturing is down. And it's because of the tariffs. Nobody's ordering. But I would argue you still want to be in this market. It's not something where I want to get completely out. Even Brian, the video that I showed you on the newsletter, he said he's 20% cash. He doesn't feel comfortable 20% cash. I don't feel comfortable. I was 40% cash. I don't feel comfortable 40%. I don't feel comfortable 20%. It's just something I have to live with because I'm protecting some cash. It doesn't mean I'm getting out. There is still opportunity. I said this yesterday and I'll stick by it. I don't think we get back to all-time highs, which was here in February at 540 on the Qs. I think we get back to probably 500, 520, somewhere in that neighborhood in a good market. Right now, it's not a good market. It will take a huge, huge lift to get back there. And I don't see anything right now out of the administration that says, yes, we're going to get there. And China certainly has a longer staying power than we do. But they're feeling the heat. Both countries are feeling the heat. Now, the tech ETF. Okay? The tech ETF. By the way, Lutnick did say there was a deal on the table and it should be announced soon. Still haven't heard any deal. Just so everybody's aware, we still haven't heard any deal. The sectors are great to invest in. XLK has been horrific year to date. Okay? But it's up 10% in 5 days. But the year to date, it's still low. Here's the top 10 holdings. Take a look under the hood, and XLK's top 10 holdings represent 61.26% of the fund. As a result of Seeking Alpha reordering the fund's top 10 according to each stock's specific quant rating, they suggest Broadcom, Palantir, Cisco, Microsoft, IBM, Nvidia, Apple. It's an interesting way to look at an ETF. Hey, let's just break down an ETF and look at the quant rating of each one to see where the opportunities are. And that is part of Seeking Alpha. And if you'd like Seeking Alpha, you can get it. Free 7-day trial. Use the link that's in the description or just go to my link tree. It's right here, the third link, and you'll get the spring sale. It includes the next Alpha pick, $30 off, and a free 7-day trial. And you can do stuff like this. And if you want to see just where the sectors are, go over here. You can go over to key market data and you can see U.S. equity sectors. There's XLK at the top. And we can go to year to date. It's the second worst. Consumer discretionary with Tesla way down is down 11%. What's your number one? Utilities. Half of these sectors are up year to date. 4.77 utilities, consumer staples, healthcare. But the overall market year to date is down 5%. The NASDAQ is down 7%. There are a lot of other countries that are up. Okay? The biggest movers of the day, Seagate Technologies. I think I brought it up. It looked like it was good. Again, it's hard drives. And I said, you know what? Hard drives, maybe there's no tariff stuff. It's up 9%. Soared after delivering stronger than expected full quarter three results, providing a bullish outlook for the current quarter. Again, there are opportunities. One of them is not solar. First Solar's tumbled 10%. Snapchat, it was a horrible quarter, and they announced, we're not giving guidance. We're not giving guidance. Now, Nader, my buddy, says that Snapchat is the best buy right now, that it'll go back to 10. It's trading under 7, I believe. Starbucks. We'll go over Starbucks in a little bit. I'll go over it. I don't think you sleep on that one. Supermicro announced. We'll go over that one as well. They're down 17%, dragging down most of the AI play. So it's not like you've got some great things in this market right now. You know, things move quickly during earnings season, and then you've got the tariff thing. Now, I will tell you, EAT, Brinker, it was down 14% yesterday, okay? This was a phenomenal quarter. Buy the dip. I will say buy the dip on this one. But here's the thing that you have to realize when you go and look at this. It's a strong buy in the quant. Wall Street says hold. There are 19 analysts that cover this. 14 of them have it as a hold. But their average price is 170. And that's 24% upside. Now, I will tell you, the 52-week range is between 53 and 192. Okay? 1 year, it's up 175%. Year to date, in a down market, this is still up 3%. It's down 1.52. The only reason EAT is down is because it's up so much in a down market. The 4-hour algorithm had you in here. I'm sorry, that's the Liberation Day strategy. Let's get out of that one and do this one. The 4-hour algorithm has you out as of right now. It got you in at 142, gets you out right now, slight loss. The 4-hour algorithm makes you 140%. Buying and holding makes you 262%. So maybe you don't want to listen to this one. This is an alpha pick stock. And I would say, look at the weekly. The MACD still extended 10 points above the oscillator. The RSI is at 50 in no man's land. At some point in time, you want to buy this one. The valuation is not extended. You know, it's a little bit, it's a C. The growth, unbelievable. 19% revenue growth year over year. Profitability, unbelievable. Even though its gross profit margin is 17%, the return on common equity, 314%. Cash from operations, $634 million. Momentum, unbelievable. But short term, it looks like it's hard because it's just profit taking. Revisions, A. Okay, 18 in the last 90 days, 1 down. And then on revenue, 13 up, 0 down. It's one to keep an eye on. Again, $9 burger, fries, and a drink at Chili's. I'm in. I haven't gone there, but that's what it is. Now, if you haven't heard of the Weinstein analysis, I will point this to you in TrendSPIDER, okay? Master Market Trends with AI-powered Weinstein Analysis. I was on a space yesterday, and one of the guys I was on a space with said, you know, this company OKTA that I had mentioned yesterday, it's entering stage 2 in the analysis, Weinstein, in the daily one. And I said, you know, what is stage 2 breakout? It is well known that the transition from stage 1, the accumulation stage, to stage 2, the advancing stage, can signal significant upside potential. And I said, you know, I don't want to trust somebody just to say that it's entering stage 2. So what can you do? Well, TrendSPIDER has built a customized Weinstein stage analysis. And if we go and look at OKTA, in the Weinstein analysis right here, you can see the red candles, and then that's stage 1. And then you get stage 2. Then you get the yellow, which is stage 3. Okay? Then you're back to stage 2. And what does stage 2 mean? Stage 2, the stock breaks out above stage 1 resistance and surges above a rising 30-week SMA, attracting momentum traders. OKTA may be attracting momentum traders. If we go and we look at it in the 4-hour algorithm, it had you in at 98. Maybe we're breaking out. We're at 112 right now. Okay? 109 in pre-market. So if you'd like Weinstein stage analysis, and again, here's the chart. It's posted on my Twitter. But if you'd like this, get TrendSPIDER, okay? Go over to Seeking Alpha, click on that top link, and you can get a 14-day trial. Import this and understand what the Weinstein stage analysis is. That's exactly how I did. I just heard somebody say, hey, it's in stage 2, and maybe it's an opportunity. Now, I was also on Spaces yesterday. Hold on one second. Stop! You got Freshworks. I listened to a space yesterday with John Fort from CNBC. It was on Spaces, and I think it was pre-recorded, but it was out there. I heard this CEO talk after his earnings. This was a phenomenal earnings. Okay? Freshworks. Phenomenal. FRSH. It's an AI company, and it was up 8%. It's still up 8%. Okay, has it reached its top? No, it's at $15. Where's $15? Right below the 200-day. Now, the 4-hour algorithm doesn't work on this one. It is a rather new stock. But what I'm going to do is I'm going to put this on the watch list because I do like this one. We're going to put it on the daily stock pick watch list, and I'm going to analyze it a little bit. This is the process of, hey, I saw something I like. I want to go research it. Let's look at the chart. Let's look at the fundamentals. Seeking Alpha Analyst, buy. Wall Street, buy. Quant, buy. Now I don't need to know anything. It's a bullish thesis. Okay, I know it's a bullish thesis. I can look at factor grades. The only one that's raising a quote-unquote red flag is valuation C+. Now I know a little bit about this company. They are making money. They don't have forward guidance, so they don't have a PEG ratio, but their growth is good. 20% revenue growth year over year. Profitability, fantastic. 84% profit margin. Okay, momentum. 25% down over 3 months. It could be a beaten down stock that has an opportunity to come back because 6 months you're up 21%, 9 months 7%, 1 year down 22%. It gets a B minus. Revisions, 12 up, 4 down on earnings per share, 10 up, 7 down on revenue. So I don't know. You say you don't know what that is. Well, let's go analyze it with AI. Who are their competitors? Salesforce, ServiceNow, and HubSpot. It is an AI software program. Okay? Now you say the valuation, I don't know how to do valuation. Represents mixed signals. The company's price to sales ratio of 5.0 is significantly higher than the sector at 2.42, indicating it's quite expensive relative to peers. However, its PEG ratio of 0.77 shows a 43% discount when growth is included. Growth exhibits remarkable growth and projected revenue growth of 16%, significantly above the sector's 7%. They are projected to grow significantly more. Again, perhaps pushing the stock price up. Profitability, commendable profitability with gross profit margin of 84%, much higher than the sector median of 51%. Momentum, it's mixed. 6 months shows a positive trend. Its 1 year performance is down 33%. Revisions, the revisions for Fresh are encouraging with 12 upward in the last 3 months compared to 5 downward. This suggests analysts are optimistic. So, and you can go and raid Seeking Alpha Analyst. Freshworks is gaining market share due to its affordable and intuitive offerings. The company is debt-free and generates strong free cash flow. Freshworks is expanding its customer base rapidly. The concerns, challenges with slow growth rates, particularly in the CX segment. I don't even know what that means. The company's strategic shift towards employee experience and its inbound-led approach for customer experience, that's what CX means, might pose near-term growth risks and disrupt ARR momentum. You can read all of that analysis right there. When it brings it up, you can read the article, when it was published, what the rating was. Okay, I own Salesforce. I don't own Freshworks. It's got a $4.26 billion market cap, so it's still got room to run. It's in the bottom half of its 52-week range. And say you don't like this one. Well, it's ranked 21 out of 89. What's the number one application software stock? Porch Group. And that's based on the quant data. And it's a strong buy. So you can go down the rabbit hole of finding other ones. And this one actually looks pretty damn good, to be honest with you. I mean, look at that, year to date, this is up 25%. It's a little bit high on the 52-week range, but it's got $631 million market cap. It's not even $1 billion. So it's a small cap. Not my thing. But again, that's how you use all of these tools to go and find it. And you can go and find a strategy that works for Freshworks. Okay, I like that chart because it shows that it doesn't have a 200-day yet because it's still rather new. The 50-day starting to turn around. Again, you've got 10% up there. It likes to trade on this 50-day. So maybe the strategy is on the weekly, when it goes under its 50-day, you buy it. When it goes over its 50-day, you sell it, or you just buy and hold. One or the other. But it's clear. I like the CEO. I liked what he was saying. You invest in leaders. I like this company. Supermicro reported early yesterday. They announced it wasn't good. It wasn't good. During Q3, some delayed customer platform decisions moved sales into Q4. That's what the company said. Supermicro's GAAP and adjusted gross margins were 220 basis points lower in the second quarter due to higher inventory reserves resulting from older generation products and expedited costs to enable time to market for new products. This is a problem, okay? Are they putting off their spend? It was a pre-announcement. The company was down 20%, okay, based on customers pushing out their buys. Does it mean Nvidia is going to be bad? Remember, they already took a $5 billion markdown just based on China. What about Dell? It's uncertain, but remember, all of the semiconductors are what's called a cyclical industry. Cyclical means that they go and order a ton of semis at some point in time, and then they typically pull back. And that's the cycle of semiconductors. That's the way it's been forever. But this one, we just don't know what it is. But Nvidia, Oracle, Broadcom, most at risk if AI CapEx cycle slows down. Klonovic. Okay, Marco Klonovic. He says that. Former JP Morgan's chief strategist. That could be the danger. So if you're heavy in tech and all of a sudden Meta and Microsoft come out and said, yeah, we're not spending on the chips. That's what they're saying. Nvidia, Oracle, and Broadcom. If they slow down on the cloud and they slow down on the AI spending, that's where you have a problem. So just be aware of that. And Meta yesterday, it's ironic. I don't know exactly what this says. But it's a day before their earnings that come out today, Meta and Microsoft. They released a standalone app. I get why. And I watched Mark Zuckerberg. It is the most awkward effing thing because those glasses look horrible on him. But the reality is the glasses are a great step forward. I like the move of releasing its own app as Google did for Gemini. Okay, I like it because what does that do? That kind of cannibalizes Apple a little bit because Apple has been bad with Siri. So what can a standalone app do? It can become your personal assistant. That's what Copilot was trying to do with Microsoft. Microsoft just did a bad job of actually promoting it. Okay, that's what Gemini did for Google. They do it great on the Google phones, the Android phones. It's horrible on the Apple phones, not the actual app, the marketing of this, the ability to use it as a personal assistant, the ability to show it. I had ants on my lawn the other day and it was a big anthill. I took out Gemini and I showed the camera and I said, what kind of ants are these? It pulled up and basically talked to me. I was able to have a conversation with what kind of ants and what kind of repellent I needed to do to get rid of those ants and to block them from moving on to the rest of the lawn. It was fantastic. But that's the type of thing that Siri should be able to do in an iPhone. So I get why they're releasing this app. And ChatGPT, the app can do it today. And it's integrated with iPhone 16, I think it is, maybe 15, but it's not a good experience. If Meta can make this a good experience, your Meta assistant will deliver relevant answers. Maybe it starts, integrating with a Meta calendar. Maybe it takes some of your Facebook stuff and says, you know what? Here's something that you can watch on your phone. It's a good idea. I don't know what it means, but the app can run with Meta glasses. Expect some type of virtual reality stuff to be placed on those glasses. My buddy John is in China walking around with those glasses. I can't believe the quality of those glasses, the quality that it does, the stabilization and the video that it provides, and the ease of use in their other new app, which you can use to edit the video. And it's automatic editing. It is great. Now, is Meta a buy? Well, we had the Snapchat release last night, and it wasn't good. Does it show a weakness in the advertising market? If it does, you could be screwed. But again, I bought it long term. Now, 7 explosive stocks with a PEG ratio under 1. We talk about the PEG ratio. This is price to earnings with growth factored in. Here's how he ranked them. PEG ratio under 1. Past 3-year revenue growth plus 10%. Forecasted 3-year revenue growth plus 10%. Free cash flow, cash plus other short terms, positive. Return on equity past 3 years plus 10%. Those are all great things. You can plug those into a Seeking Alpha scanner. He gave you the stocks, though. You don't even need to do this. Google, I like it. Nvidia, I like it. Meta, I like it. Eli Lilly, I like it. Melli, Mercado Libre, I like it. Nubank, I don't know it. On, I'm not a fan. So go and research those stocks, but it's 10 stocks. I like 7 stocks with a PEG ratio. One stock that I like is Wells Fargo. I own a lot of this. I own a lot of this at 38. I own a lot of this at 45. I own a lot of this at 50. I own a lot of this at 60. It's trading at $69 right now. And they announced a $40 billion buyback. In Tuesday midday trading, most of the biggest 6 banks after the bank authorized a $40 billion buyback. Just to give you an idea, that is 18% of the market cap. So today, if they bought back $40 billion of their stock and they retired, they won't retire at all. But if they retire 5%, that's 5% in your pocket. Nothing. Because if they take the stock back and they own it and they retire it, some of this might be for executive compensation, things of that sort. But again, that is what a company does when their stock is at a value they believe. Look at it, 52-week range goes all the way up to 81. It's a strong buy in the quant. $40 billion. When you go to sell this stock, guess who's buying it right now? It's Wells Fargo. $40 billion. That's a huge one. Another good stock. Oh, you know what? Before I go with that, CrowdStrike. Let's talk about CrowdStrike. I just have a note. There's nothing that came out. There's nothing, they announced some new protections yesterday, but that didn't necessarily move the market. But I want to point out to you what a strategy involves. And so CrowdStrike, as it gets up to this 440, 450 range, I had an alert yesterday. And I said, you know what? I want to know when it gets up here. It hit 430 yesterday, and I got the alert. I want to start trimming. Why do I want to start trimming? Well, let's go take a look at the chart. Even though I think this one kills it on their earnings, I bought it down here at about 340, 350, somewhere in that neighborhood. It's at $430. That's a big move in just 21 days, 3 weeks? And the 50-day is about to cross up on the 200, a golden cross. But I want to be alerted because what do I see? Well, I see, when I look at this weekly chart, I see it coming back up on the MACD up here where it rejected at 450, 455, somewhere in that neighborhood. 454 here in February 10th and 455 February 17th. And where's your high today? 432 on this week. Just an alert. I'm not trimming yet. It is down in pre-market, but you want to add to your winners and cut your losers. If this one starts to turn down again, like it did, it went all the way from 455, 2 weeks later, the low, 318. That's huge. That's enormously down. So I just set an alert and I said, you know what? Keep an eye on it. And if we start to turn down because GDP starts to be revised down, because the jobs market starts to decline, because the Fed doesn't lower rates in May, because the bond rates start going up, I want to keep an eye on it. That's how you manage positions. That's why I say don't have 80 positions in your portfolio. Have a concentrated position. Identify which ones are trades. Identify which ones you want to get rid of. Because one reason to sell that I put in my newsletter, when you go over to my newsletter, one of the top reads is when to sell stocks, a collaboration. This is when to sell stocks. MACD cross down, RSI oversold, 52-week or all-time highs. That's where you want to start looking at trimming. So again, that article is great. It's out there. You can read it. You can do whatever. Now, I get asked yesterday about a Canadian energy stock. I'm not an energy guy. Just be aware. I am not an energy guy. I can look at the PE of a stock just like anybody else. I can look at the PEG ratio just like anybody else. I can look at the dividend rate. There is one energy stock that I recommend and that I've owned for a very long time. It's in the core portfolio. It's MPLX. Okay, why? They just announced a 95-cent dividend. That's a 7% annual yield, 7.35%. They just announced it. And I'm going to get paid on it. Now, why do I recommend this? Well, let's go and look at the metrics. If we go in performance and we go to total return, that includes the dividend. And we look at 1 year. Look, MPLX up 34%. 1 year, SPY, S&P is up 8%. 3 years, MPLX up 108%. S&P up 34%. 5 years, MPLX up 359%. S&P up 89%. Okay, when you get to the 10-year mark, because energy was not performing very well back here, it underperforms as the SPY went. But I own this one for the 3 to 5 year time frame. And I bought this one in 2020, sold a bunch, okay, in I think 2022, 2023 after it run up. And I bought back in. And I continue to hold this one. This is the only one that I actually know. And I don't know nothing about what they do. I just know it pays a 7.35% dividend. It beats SPY. And do I care what else they do or what else in the oil and gas place they do? No. I don't know if they do natural gas. I don't know if they do oil. I have no idea about the details of this one. I just know it performs really, really well. Okay? One other one that I know and I trust in the management. Don't bet against this. Starbucks is down 10%. It was a bad quarter. But the CEO says he's got everything on track. Nichols said the full quarter 2 earnings results were below its capabilities, but are only temporary. Trust this man. He's got a track record of turning things around. Look at Taco Bell. Look at Chipotle. His plan, same thing. Simplify the menu and change things. That's what he's been doing, keeping an eye on. He's been there for less than a year. Don't bet against Starbucks. Now, the quarter was bad. Do you want to buy it now? Look at that one. Buy into some type of strength. You don't buy into weakness. You buy into some type of strength. Okay, right now there's weakness on this one. This is why you don't buy before earnings on a company that has a new CEO, but you buy into strength. Now, did you want to buy at 84? I would say no. The 4-hour algorithm doesn't work on this one. It just doesn't. You know, you win only 29% of the time. So you need to find a strategy that works. But don't bet against this stock. You know, this one was clearly in a range here. And you could buy down at this bottom part or even down here. Now it's heading down. This was when the new CEO was announced, August 19th. And that's when it popped. And we saw that pop up. Now reality's starting to set in. He wasn't able to change things super, super fast. But don't bet against it. Okay? Grab. Grab reported overnight. Let's go look at Grab in the pre-market. Because I think it was up like 1% or 2% or something like that. It's down 2%. It was a good quarter. Okay, they reported overnight. What's funny, this is an article like Uber, Grab is building a winner takes most platform. I love Uber. I don't know much about Grab, but this guy does. GARP Businesses, he believes it's growth at a reasonable price. And so if we look at Grab, again, it was up 0.63% yesterday. It's up down 2.71. The valuation's expensive. But what I find it funny is that passenger and ground, I love Uber. Uber is ranked number 4 within the quant. Hertz, Lyft, and Grab are above it. So go and pick your winner. That's all you have to do. Now, earnings. We've got Microsoft, Meta, Robinhood, Qualcomm. You've got a bunch of other Sprouts Farmers Market. You've got a bunch today. With the news coming out, I would be buying into weakness. You know, Microsoft, I'd rather see it go into earnings at 360 than 390. Meta, I would rather see it go into earnings under 500 than at 540. You know, Qualcomm, I'd rather see it go in at 130 than at 145. We've seen strength. They need to hold up in order to build that strength. Meta was down on the Snap results. I would not expect a huge beat. Now, I will tell you, if you go over my Twitter, I'm not going to include this in the newsletter. This is exclusive for those that listen, but go over my Twitter and Gene Munster, let's just look up Gene Munster because he put out exactly what to look at over this time. As for CapEx, blah, 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 let's say Meta earnings preview. Here you go. Forget about March. It's all about the outlook. He goes over all of what to look at in Meta. So you can do that. And that's it for the show. I am on vacation tomorrow and Friday. If you have any questions, you can hit me up. Remember, the Seeking Alpha sale, it continues. So make sure you don't miss out on that one. $30 off, free 7-day trial, and the free alpha pick. If you'd like TrendSPIDER, you get my 4-hour algorithm. I do get an alert when you sign up for an annual plan, and I do respond. When you sign up for the 2-week trial, you get just what you get with TrendSPIDER, but once you sign up for the annual plan, I will send you whatever I use, all the watch lists, the custom scanners, everything. But go and try it. I would suggest going and try it. I showed you what it does with Weinstein. It is such a deep program. But again, if you have any questions, hit me up. The newsletter is there. You can just reply to the newsletter. Anything that you need, I'm here for you. Okay? Talk to you later. Bye.
Every morning I wake up to the sound of the trading bell. My heart starts to pound. Daily stock pick trading podcast in my ears, guiding me through my hopes and fears. Tune in daily, don't miss a single show. Sign up for the newsletter, let us help you grow. Taking risks, making moves, seeking success. Together we'll conquer, no room for any less. Every morning I wake up to the sound of the trading bell. My heart starts to pound. Daily stock pick trading podcast in my ears, guiding me through my hopes and fears.